This recording we're going to look at Summer 18 question 3, focused particularly on trade receivables and bad debt journal entries. So this is a typical CAP1 question that's examined again in the CAP2 interim assessment. So it's important to understand your CAP1 double entry bookkeeping. So elements of control accounts, bank reconciliations, suspense accounts are all heavily examined again at your CAP2 financial reporting interim assessment. So this is 15 marks in September 18. Remember, you have a 90-minute exam, so that means 15% of your time should be spent in this question 3. So it's a short enough one compared to question 1 and 2. But again, it's important to give it enough time, somewhere around 12 to 13 minutes in terms of what's required. So part A is asking you, prepare the journal entries to record the necessary transactions, and then calculate the closing bad debt provision at the end of 2017. Right, so for 15 marks. So again, I'm assuming you've read through the question. If not, try and pause this and read through it and then come back. So just see, can we increase that a small bit? So what we're looking at here then is you're given the trade receivables figure. Be careful in your dates now at the end of 17, pre-adjustments. So we know we have to adjust it off. And that 336 then is split down here as well in terms of an age debtor analysis. And you're told the opening bad debt provision. Remember, at the end of 16 is the start of 17. So watch your dates there. And that's 12.8. And again, they tell you how to calculate the closing provision. What we have to do is make the adjustments first, because that 336 is wrong, because you're going to have adjustments for all of these figures first. So it's important, read the question early on. Don't waste time jumping straight into it, because you'll probably have to come back and repeat yourself when you realise what the adjustments are. So in terms of adjustment 1, they're telling us here, trade receivable in the 3 months to 1 year category, owing 6,000, become bankrupt and should be written off. This is what we call a normal bad debt. That would just be debit bad debt expense and credit trade receivables. When you know the receivable to actually be written off, it's credit trade receivables directly, like a normal bad debt, 6,000 and 6,000. And again, we'll need to take note of that adjustment when we're calculating the closing provision. This is now going from 28 down to 22,000. Adjustment 2. You agreed a credit note request for 1,000 of its receivables in the 1 to 2 months category. So a credit note essentially means you're writing it down, you're giving them a note for some of the revenue, and that will be debit revenue, because you're reducing your revenue by issuing a credit note, credit trade receivables. So nice simple journals, but get each of those marks, because every journal is worth marks. There's 10 marks going for those journals, so slot them in as you go along. And remember, be savvy as well. If you're stuck on one, don't waste time and do all the rest of them and come back to it. Right? There's no point getting caught up on one and not being able to do the rest that come after it. So next one then is Galvity issue credit sales in 31st December for 8,000. So they recorded that sale, but the goods did not leave the warehouse until the 1st of January 18. So the trick here was this was not a sale at the end of the year and shouldn't have been recorded as sale. It should only be recorded sale once the goods are delivered to the customer. So we have to reverse that sale, debit revenue and credit trade receivables, 8,000. And again, a lot of students would have got that adjustment on the day of the exam. What you'd also ask yourself is, why am I told this then? The markup of 25% on sales. What they're trying to tell you there is, well, if that's not a sale, you have to bring it back into inventory. Because if you recognize the sale too early, that means you took the goods out of inventory as well. They should be in closing inventory at the end of the year. So trying to increase closing inventory, it's going to be debit inventory, in brackets there, CA for current asset. You're going to credit cost of sales. Because by increasing your closing inventory, that reduces your cost of sales. It won't be the 8,000. So Galvity makes a markup of 25% on sales. So what that means is the 8,000 is going to be 125% of your actual cost of the amount. So that's an important thing to think of is the 8,000 is when I add on the 25%, but we know we record inventory at cost. So you need to work back to what was the cost of that. So you divide by 1.25. Okay, and we get that figure here. It's going to be 8,000 divided by 1.25 is 6,400. So again, these are marks. Don't just look at the core trade receivable, think, well, why am I told about the markup? You have to use that somewhere. So always try and be savvy in the exam. Why am I given certain information? The examiner is giving me a hint of where they want entries to go. So adjustment 4 then, this is looking at a bad debt recovered that had been previously written off and lodged the bank account. Now, there's a short and a longer way of doing a bad debt recovered. The longer way would be to debit trade receivables and credit bad debt recovered in the SOPL. Now, you can also credit bad debt expense. Sometimes they're netted together. Either of those would have got you your mark there, and that would have been 2000. So you first write back the bad debt to say the bad debt is still owing, and you credit bad debt recovered, and then what you will do is debit bank and credit trade receivables. 2000. So that's the longer way of doing it, because if you take out this one and this one, you're just left with the two entries on row 19 and row 21. That's the shorter way. So if you give me just this entry, debit bank, credit bad debt recovered, that would also be acceptable. Right, the main logic of putting them through trade receivables and taking it out is you now have a record of which customer actually had a bad debt recovered. Whereas if you just take row 19 and row 21, you won't actually know which customer ended up paying you back the amount you're written off. Just for management purposes, you go the long way around, but the net impact is nil on your trade receivable. You're debiting and you're crediting. So either approach would have got you your marks there. And last but not least, in adjustment 5, here you're told at the end of the year, Galvity received a check of 3.8 from a trade receivable in the 2 to 3 months category. Receivable owed 4,000, allowing for a discount. So you're trying to do a combination here. To start with the easy one, you're going to debit bank, and that's going to be 3.8. That's how much you got in from the settlement. And you're also going to credit trade receivables 4,000. You said they've paid it completely, gotten it off. Now they've paid less than what they owed, but the difference is a discount on the balance. So the difference there is 200 on the debit side, and we know for customers that's a discount allowed. So you would debit discount allowed, which is an expense. So you're saying you're extinguishing the amount of money you owed, 4,000. Of that you got paid 3.8 and you allowed a discount of 200. So they're nice little journals, but remember, 10 marks, 10% of your time, there's only about 9 minutes to do a question like that. So again, CAP1 is heavily examined. We'll go back, particularly look at question 3s in the past papers, suspense accounts, trade receivable control accounts, bank reconciliations. You don't have that much time, so you can't be trying to study it out in the day. You need to practice these because you will be tight for time pressure, particularly when you do your question 1 and question 2, most likely first. Now, part B then is asking us calculate the closing bad debt provision to be included. Now, we know the opening provision up here is 12.8, and they've given us the percentages across each of them. So you can see that kind of make logical sense. The longer the period owing, the more likely those are going to be bad debts. We don't know exactly, but we create an increasing provision. Sometimes a question just gives you a single percentage. Here it's been a bit more complex. So we'll just write it out then. You have less than 1 month. You have 1 to 2 months. You have 2 to 3 months. You have 3 months to 1 year. And you have greater than 1 year. So we're just trying to list it out like that. We'll call the draft balance is what we're given already. 120, 130, 46, 28, and 12. So remember now the trick here was you've made adjustments. So you have to come up with the final balance before you make the provision. That's what a lot of students would have done, is just take the percentages simplistically there. That's not going to get you your answer, because that is the 336 as you're told above. They are pre-adjustments. So what adjustments do we have for less than 1 month? So if you go down over here, the less than 1 month. So the obvious one here will be this one. And this is a tricky one, adjustment 3. You're only after making a sale on 31st December. So by definition, you would have had that sale in the 1 month. We know that's now wrong. So we're going to do minus 8,000 there. That shouldn't have been in there. And if you want a reference there, what I'll put in, and a good student might do this as well, you'll reference there adjustment 3 to show that's where that adjustment is coming from. We reversed that sale. It was only outstanding for a day. So it would have been in the less than 1 month category. In 1 to 2 months then, if you look down along, you see here, you have a credit note. So that is going to be adjustment 2 and minus 1,000. So where you can in your exam, make it clear to the examiner exactly where your adjustments are coming from. One big failing for students is they throw down figures, but there's no workings involved. You need to show your workings to get your marks. In 2 to 3 months, you have down here the amount that was paid off. So you're going to have minus 4,000. That is adjustment 5. That is minus 4,000. So although they only paid 3,800, we credited the full 4. So that's where it comes off. In 3 months to 1 year, you see up adjustment 1. That's going to be minus 6,000, which is your bad debt. And then greater than 1 year, there has been no adjustment, so that is as is. And all we do then is adjust downwards as required to get our closing final balances on each one. Right. So your closing trade receivables now are going to be 317,000. Now we don't just take a single percentage off them. What we're going to do is get our provision based on the percentages here. So 1% of 112, 3% of 129. So we'll call that the bad debt provision. So there is a bit of work here for 5 marks. And the important thing is it does take a bit of time as well. So you need to practice under time pressure to make sure you're happy. So 112,000 times 1%, that'll be 1120. 129,000 times 3%, 42,000 times 4%, 22,000 times 10%. So the longer it's outstanding, the bigger portion we expect not to be paid, which makes logical sense because it's less likely you're going to get that money in if they're that long outstanding. And finally then 12,000 times 40%. And what you do then is you add all of those up, and that becomes your new provision. We call that the 31st to 12th, 17. That's the new provision at the end of the year. Right? So remember, and you're not asked here, but for a good student, what they'll say is your trade receivables in the statement of financial position 2017, that will be 317,000, which is the updated trade receivable figure minus the full amount. So just watch if they ask you that. That's what the closing trade receivable figure will be in current assets. It will be 303,330. But they just didn't ask that here. You always show the trade receivable net of the full provision. But what we also have to do, and it was a tricky part, you had to give a final journal, because this is really required in part A, but it's linked to part B. Our opening provision at the 31st of 12, 2016 was 12,800. So that means you have an increase in the provision of 870. So your final journal that is required here is to recognize that increase in the provision. So remember, when you have an opening balance in the provision, you do not recognize the full amount. And the debit and credit here will be debit, bad debt expense, because an increase is bad, because you expect more people not to pay you. So debit that expense 870 and credit your bad debt provision. You're bringing it up from 12,800, which is an opening balance, up to 13,670. So credit bad debt provision 870. Right? So that's quite tricky, and that was where part B is linked into part A. And so overall, that's a nice short question, but there is a good bit of time involved for 12 or 13 minutes. So it's important to go back, particularly at question 3 in this exam. A lot of the time, it can be CAP1 topics. So look at your bad debts, look at your trade receivable control accounts, your trade payable control accounts, suspense accounts, bank reconciliations. All of those have been asked in the past. So that was September 2018, question 3 on trade receivables, bad debts, and bad debt provisions.